All right, guys, Google and Microsoft are both down significantly after hours when they reported their revenue and profit for the quarter. Here is the breakdown of Google. So this is the actual press release from Alphabet. It's not going to compare to estimates because their focus is purely going to be on what's right, which is what they actually did. So first off, this is for the quarter ending March 31st. Last year, they had $55 billion in revenue. This year, $68 billion. That's an increase of 23%. That's pretty solid for such a big company. Operating income, 16.4 to 20 billion. Now here's the big kicker. Here's why their net income is down. In the previous year, their other income was 4.8 billion, and they had an other expense of 1.16. That is a $6 billion swing. That is why their earnings, their net income went down, and their earnings per share went down. Okay, so keep that in mind that companies will have other income and expenses when looking forward. That could be because they wrote something down because they realized it wasn't worth what they thought it was worth. They might have sold something or for a gain or loss. These things do happen. And I want to focus mostly on the operating income. When you look at the operating income, that's how you find how the company is actually doing itself. Is it getting better at their operations? And this shows me they got 30% better from this standpoint. Okay. Next, here is the breakdown of the revenue by sector. So Google advertising went from 44.7 billion to 54 billion. And that was broken down. You're watching us on YouTube. $6 billion in ad revenue to 6.869. That is that's a 13% increase in revenue for just Google YouTube ads. From Google search, 31.9 to 39.6. So all growth along the way. Google other, I don't know what's entailed in that one, but 6.5 to 6.8. For Google services total, 51.1 to 61.5, about a 20% increase, okay? Google Cloud, guys, as we talk about, the cloud is getting big for everybody. This is AWS, Microsoft, Oracle, all these big companies IBM, they get into the cloud because it's very, very high margin. So we always talk about that. When everybody preaches about AWS and how amazing it is, it's still a high margin business with a lot of competition. And look at this growth. This is still substantial growth. This is over 45% growth number in their revenue for Google Cloud. Okay. Revenue for other bets, they call this other bets, 200 to 440, and their hedging gains and losses, boom, that's whatever. So for a total revenue of 55.3 to $68 billion. I don't know what total TAC is. I have to look that up. But either way, number of employees, look at this jump in employees, Tim. They're from 140,000 to 163,900 employees in 1 year. All right. Now, their operating income, Google services made 19.5 billion last year to 23 billion. Google Cloud actually lost less money, but it still lost money this year and last year, which I'm kind of surprised about. Such a high margin business. Other bets, they lost about $10 million more in other bets, and their corporate costs a little bit less. For net income, total income from operations, from 16.4 to $20 billion. All right, not bad. Big thing. The $70 billion stock buyback. They're going to purchase 70 billion of its Class A and Class C shares. That's GOOG and GOOGL. Okay. I think they have a stock split coming soon, don't they? A 20-for-1 stock split is coming soon. So that'll make it easier for people to trade this stock if you want to trade it or sell options on it. Let's say you have 10 shares right now, 5 shares right now, and you get a 20-for-1 stock split. You're not going to have 100 shares. It will allow you to now enter into a contract to sell covered calls. Or if you want to buy $10,000, whatever the price is, $10,000 worth or whatever the number is, you'll be able to buy that now with the stock split. So keep that in mind as well. But these are very big. Listen, would I be buying Google stock back? I don't know. Let's go look at the company from an 8-pillar perspective. So Google, the Goog. Let me make this bigger. Oops, that was too big. Well, the stock is down. So the stock hit a high of 3,030 this year and a low of 2,200, and it's currently sitting at 2,265. All right, so 5-year PE is our first pillar. We have 38.72. We want it to be under 22.5. It's a little high. No dividend, but a high return on invested capital. We want over 9%. It's currently 13.3%. That's pretty solid, okay? Next, we want revenue growth. This is clear, guys. Clear revenue growth. Let's go 4 quarters. $117 billion to $257 billion. Over double in the last 5 years. Net income, I don't think you're going to be shocked to see, look at this number, Tim. $12.7 billion to $76 billion. That is huge. Now, these numbers do not include today's announcements because we get data feed from somebody else, so it's going to take a few days to get there, but it's coming close. Now, stock buybacks. So look at this. They had 689 million shares outstanding at the beginning of year 5, end of year 6 years ago. Now they're at 662, and they're announcing another $70 billion. So let's say the stock stays the same. 70 billion divided by a 2,300 share price. They're buying back 30 million more shares, 30.4 million more shares based on today's number of shares. So they do a 20-for-1 split. They're talking about 600 million shares more they're buying back after the split. That's a lot, okay? So that's about 5% of their shares outstanding. Let's go to the balance sheet. So what we want to do is we want the long-term liabilities to be easily managed by their cash flow. So we look at their 5-year average free cash flow, 37.5. We multiply by that 5. That's $185 billion, roughly. Correct? 5 times 30 is 150. 5 times, yep, correct. We want their long-term liabilities under 185. Spoiler alert, guys, it's way lower. We go to the balance sheet, go all the way to the bottom, $43 billion. They can basically do it in 1 year. So this is a company that has such little debt, it's going to be hard for them to go under even if they see hard times. This is a very, very, very good company financially. Healthy company. Next thing we want to do is look at their free cash flow. So guys, their free cash flow the last 5 years, 24 to 67 billion, check mark. And our final number is we want to look at their 5-year average free cash flow, 37.5, multiply it by 20. That is 740, call it $750 billion. That's what we want to pay for the company. It's currently selling for, market cap wise, 1.5 billion, double that. Now, does that mean it's overpriced? I don't know. If they can grow at 20 or 30% a year for the next 5 or 10 years, that's pretty awesome. So let's go to our stock analyzer tool and find out if it's a reasonable price to pay for the company. Now, this stock analyzer tool was created because the future is unknown, but every investment is the present value of all future cash flow. So we have to figure out what is that future cash flow worth to us today. Now, I'm going to take very conservative assumptions, just like Warren Buffett, Charlie Munger, Motors Pabrai, all these guys do. Why? Because I want to make my investments on conservative assumptions because when I'm wrong, I want to lose very little. Now, does that exclude me from some investments? Absolutely. But in the long run, this is the method that all value investors use to crush the market. So revenue growth. I'm going to go 7, 10, and 13. Profit margin, I'm doing a 10-year analysis. Profit margin of 20, 21.5, and 23. Free cash flow margin, 21, 22, and 23. PE, 14, 16, 18. Because they're still Google. They still own the world of search. And a 12.5% return, guys, because you can invest in an ETF and get 9 or 10%. So in order to get margin of safety and make it worth your while, give yourself a higher return. Hit the analyze button. All right. So on the highest level, we're there. 25.60. Look, the stock has gone down even further since we started this video. It's now down 9%. The low end of $1,300. So somewhere in the middle, $1,800. Okay. I don't know if this is right or wrong, but it depends on the assumptions. If you believe these assumptions, you should buy it all day today. If you believe these assumptions, you got a lot longer to wait. It's going to fall another $1,000 a share. And if you believe these middle assumptions, 20% more drop, and that can happen tomorrow. For those of you who don't believe that, go look at any number of stocks that have fallen. Look at Microsoft. It's fallen a ton. Look at Peloton. All these companies can fall very quickly. So be patient. It'll be a good time to buy. The great news is with our software, I can add to my watch list at this price. If it falls below, notify me. Boom. Now I'm getting notification on my phone and the software when it's ready at that price, and I can go in there and do a little bit more due diligence, make sure I like the company, and start my position. So that's Google right now. Thanks very much.